Hello everyone, welcome back to the channel. Matt with Green Bar Trading. Welcome back to another weekly watch list video where we're going to go over everything you need to know for the week ahead. All right, let's jump right into it with the earnings for the week. We have Nike on Tuesday. FedEx on Tuesday also is going to be a big one. Last earnings, FedEx had warned of a global recession. So it's going to be interesting to see what another 3-4 months have done in that company, see what they have and what they've seen, and what they say in the earnings call is going to be really important. And we'll just have to, take our cues from a global delivery company, all right? Because they don't just work in the US, they're all over the world. That's why a lot of people pay really close attention to that earnings report. All right, so earnings, not much else going on there, but if you are interested in trading these companies, that's who has earnings this week. All right, let's go over to our economic calendar. And what we need to do is we have to go back to last week, because last week we saw the biggest moves, right? We went into the week knowing that all we were interested in was the CPI and Powell, all right? So last Tuesday and last Wednesday, those were the days to really pay attention, and that's what we saw here. So on the CPI report, inflation came in. While it's still high, it beat expectations. And the market in the pre-market session loved it. So we gapped up a huge amount. Now I'm going to get into the charts in a little bit, but the market really liked that in the pre-market, and it skyrocketed. Less inflation means that the Fed can maybe start to cut back a little bit and don't have to be so hawkish. Okay, that didn't last that long, because then on Wednesday, we got the federal funds rate announcement. They raised 50 basis points. That was all expected, so nothing shocking there. The only thing that was a little surprising to the market is they raised the federal funds terminal rate, that high level rate that they're going to get to. They raised that for next year. So, thinking that they're going to have to keep rates higher for longer. You heard Powell say that over and over. We have to keep rates higher for longer. The market did not like that. And then we saw a really big pullback that has not stopped yet, okay? It just carried on for the next couple of days after that. But we'll go into the charts in just a minute. Now, looking ahead, all right? Looking ahead, I don't care about Monday. I don't care about Tuesday. Consumer confidence index, whatever, that can sometimes move markets a little bit. What I really do care about is some jobs situations, okay? Some jobs numbers. Initial claims, they have tended to move the market a decent amount, as the Fed is definitely looking at the labor market right now. I think that everybody is under the assumption by now that inflation is starting to roll over, so that's not really that much of a story anymore. The new story is going to be that labor market, all right? The Fed does not like a tight labor market. They want it to loosen up a little bit. They want unemployment to go up a little bit. They want average earnings per hour to come on down a little bit, so that inflation doesn't keep getting passed on to the consumer, because if companies have to pay workers more, there's not enough workers, to fill those spots. They have to pass that on to the customer, which just makes inflation, stay here forever. So they're going to be fighting the labor market, and those data points are going to be important. So you have that on Thursday, and then on Friday we have the PCE. Now, the PCE is probably the Fed's most watched inflation gauge. Now, you might think, I thought CPI was. Not really. They do look at the CPI, don't get me wrong, but it's the core PCE that they really, really look at. And that's where they get, that inflation number. They want to see 2%. That's where they get that from, that core PCE. So we'll have to be aware of that on Friday. That can definitely move the markets. All right, so that's the economic calendar. I think we went over all that. Now, what we see here with the bond market, all right, this is really important because this has really predicted a recession just about every single time that we see these things. So right now, you have the 1 month and you have the 3 month. This is what they're yielding right here. And you have the longer dated treasury yields that are now yielding much lower than the shorter duration treasury yields. That is almost always a clear sign of a recession coming. All right? It's just a huge inversion, very big inversion here between the short term and the longer term maturities here. That is just, always showing ahead of time that that recession fear is there. And I'll show you guys here. This is just an article, and this article was actually from October. So now this is even lower. This is really low now. And that always, before that happens, has been a clear sign of recession coming. You can see in that gray shaded area, when the curve inversion goes below 0, like you see there, after that, you see a recession within 6-12 months after that. So the bond market is trying to tell us something. Will we listen? That is, the bottom line there. So that's what they're showing us. That's the bond yields, and that's how they moved recently. Now, looking at the ETF map here, this is a heat map of the ETFs. Every ETF in the US market, 1 week relative performance, okay? This is what they've done on the week. Now, you can find this on FinViz, just click on maps, and you can get heat maps on just about anything. The S&P 500, the stocks that are in that, all 500 stocks. You can see Apple was down over 5% on the week, and you can just come on here and just kind of play around with it. It also gives you guys a large amount of different inverse ETFs that you might not be aware of. Now, I'm sure most of you are aware of SQQQ and TQQQ. That's a triple leveraged for the NASDAQ market, the TQQQ, that goes up 3 times the amount of the Qs. It also goes down 3 times of the Qs. So if the QQQ is down, 2-3%, this will be down 9 to 9%. And that's what you see here on the week. SQQQ goes up 3 times the amount that the Qs go down. All right, same thing here with the SPXS. This is a bear ETF, so this will go up when the SPY goes down. So if you like to trade things that go up, you can look at inverse ETFs to trade. They're very popular. All right, so that's that. Now, let's just go over to our compass, the SPY. This is what we see here on the daily chart. If you're new to these videos, I'm going to go over what these indicators are really quickly, because I look at these 3 indicators on the daily chart. I have this cream colored indicator is the 50-day moving average. The orange is the 200-day moving average. And then I have the 20 EMA in here, this blue colored indicator. So those are the ones that I look at for direction. I also look at technical analysis with trend lines and key levels. All right. So what we saw in the past, just about over a little bit over a month, is we've been trading in this range right here for a long time. All right. Going up, coming back down, seeing a lot of support down here. Well, that support broke once this trend line broke. Now, what's interesting about this trend line is you have this area right here. And I'm going to get into the exact day that this was in a second, because it's very interesting that we had the same thing happen right there. Now, we called this out during our live stream that morning when we were gapping up into resistance, but over that trend line in the pre-market session. So we gapped up, we opened the day. This is the CPI report. The CPI report was very good, like we just went over. It beat expectations, so we gapped up, but look where we closed. So we gapped over that trend line that has been very clear for the year, but closed inside the trend line. Very, very bearish. And the next day you can see here, it tested that trend line to the penny and then sold back off, and then we just continued to break down from there. All right, on high volume. So not very good look for the market right now. But what happened here 2 CPIs ago was a very bad report. So the way that the candlesticks work is the day opened up right here, because these reports come in before the market opens. So bad CPI report, the market sold off huge in the pre-market, and then during the market session rallied and got inside this trend line. All right, same thing happened here, but to the other side. This is really important, right? So you would think a bad CPI report, it shouldn't get a lot of buying. You should think a good CPI report shouldn't get a lot of selling. Well, this is why market structure is so important. It doesn't matter the report. If you're getting a bad report already at the bottom of the market, well, that's where you're going to see if there's a lot of supply here, a lot of demand here, and that's why it gets pushed up, because all the bad news is already baked in. Right here, that inflation news, all that good news was already baked in at this point. We were already up from the bottoms here to the top, 17% move on the S&P 500. So at this point, market structure, we were overbought, right? We were coming into resistance. It didn't matter about a good report. Market structure was telling us that we're already, just nobody, there's no more buyers here. There's just a lot of supply up here, and that is market structure. So there was a lot of demand down here. Bad report, nobody cared. Sentiment was already so low, and that's when we saw a rally. Same thing up here was there's a lot of overhead supply, resistance. A great report didn't matter, okay? So we have to know those emotions of market participants in the marketplace. These are markets that are just traded on emotions. So you could get great reports, you could get terrible reports, and see those reversals if you're at the bottom of the market and if you're at the top of that rally. So you need to know that market structure. It's very important. So anyway, the SPY closed under the 50 moving average. A really terrible week. I mean, there's no way that you could put a good spin on this past week. I mean, look at this candle here. Look at that candle from 410. Look at that topping tail to close just about at the lows. That is an ugly weekly candle. All right, this would suggest some more downside here. So that's the SPY there. Going back to the daily chart, looking at the Qs now. Again, I mean, same situation. We rallied up into overhead supply, sold off, broke trend lines, broke key levels at 280 that we've basically been in for a pretty decent amount of time right here. Broke out of that consolidation, and now we're coming on down. All right, so if 272 breaks here, you can get down to the lows pretty quickly. I mean, we're not that far off from previous lows. So definitely be aware of the cues and how bad this daily chart looks. All right, now looking at the Dow Jones, you can see here, up here, there's just a huge amount of supply. This is a supply zone here. You can see with this huge sell-off, all right? CPI went up into this and just got sold off. Now, the only thing is, I'm going to change this color because it's no longer resistance. This is a trend line for the year. We broke out of that, and now we're retesting it. Currently, the Dow is still the better looking ETF, the better looking market at the moment, because we're over this trend line and we're over both of these very key indicators on the daily chart, the 200-day and the 50-day. So the Dow is definitely holding up better than the rest, but there's just no more buying that seems to want to happen over here. So your risk to reward on the upside, I mean, it stops here. This is where it stops. So in order to break out of this, it's going to take an awful lot, and I do not see that coming. We could chop around a little bit, or we can pull all the way back. Just keep in mind that that's the Dow Jones Industrial. Looking at the IWM, very clear resistance right around this area all year long, and now we're rolling over under every indicator. Not good, not good at all. Looking at the weekly chart on the Russell 2K, it looks to me like this wants to come back down and test these lower areas here. So all the markets right now outside of the Dow, you know, even the Dow is not looking great. These weekly candles are really bad. The market in general is not looking so good. So, you know, keep that in mind. This selling could continue for a few more days until it starts to rally a little bit. But that's what we're looking at right now. All right. Now, going into a couple of stocks that I have here on watch. I'm going to start with Moderna. That's mRNA. This is the weekly chart. Let's go over the daily. This is where we saw that breakout. So you have a very clear cup, handle, breakout, coming back down to retest that area. So this is where I'm interested in. Right in this area, this 188 to 190. So I'm going to set an alert. Let's create an alert here at or above 189. Yeah, that's good. All right, I'm going to create an alert. If it comes down to this area, I'm going to look to possibly play that bounce if it holds up. And this is what I suggest that all of you guys do, is set alerts on this stuff. That way it goes off and you don't have to wait for everything and get antsy and start taking trades that don't make sense. Set alerts. If it triggers, go in, see what it looks like, see what the overall market is doing, and then build from there. All right, so that's that. AMD is the next one. To me, this is a failed cup and handle. All right, so you have the cup here, the handle, and the breakout that didn't happen, and now we're breaking down and we're under the 50. This looks like it is going to continue on down. That's AMD, very bearish looking, broken little chart here. So that's AMD on the short side. Let's look at Netflix. This is something that we called out on a few weeks ago for a gap fill that happened last week. So right here after earnings, it sells off and then takes all of this amount of time to get back, fill that gap, and then start to sell off again. So I can see this one, now that it filled the gap, to continue to come on down if the overall market continues to come on down. That's really important here. But it already filled the gap, so that's out of the way. This would have been a good spot to set an alert and get short at that point. All right, so that's Netflix. Let's look at Tesla, which has been absolutely destroyed. Really bad. Look at this on the weekly. All right, so here's our weekly chart on Tesla. We have this channel here that you're trading in for the past year. You're currently at the bottom of this. It's possible with things so oversold, I'm going to go back to the daily chart. You're so oversold at this that maybe we could get a bit of a bounce. All right, so that's what I would be looking for here at the 150 area, for maybe a little bit of a bounce back up. But you'll have to see if it starts to base out a little bit. But to me, this is oversold big time, and for good reason. But it's going back down to this channel for maybe that little bit of a bounce. We'll see what happens, but that's Tesla looking for that long for a bounce. And then you have Apple coming into right down here, support. All right, you're back in that area here. I set an alert this morning already for 131 or under. I'm going to look to get long. This was not a very good day on Friday with this huge red candle. So we'll have to see what happens here. But looking at it on the weekly, you can see here very clear that it's coming into a demand zone. So we'll see what happens on Monday, Tuesday, next week. The RSI is low. We'll see if we could get that bounce. On Apple at some point, I would be looking, the RSI is very oversold. I do think that a bounce can happen. And if the market has a really, really bad day this week coming up, like a huge sell-off, that could be an interesting time to possibly get a dip buy. But we'll have to keep an eye on that and the overall markets. We know our key levels, so that's that. Looking at the VIX, let's get into that one. We're almost done here. The VIX we saw here in a couple weeks ago posted that we were coming into support. We saw the bounce, came back down, and now we're kind of just treading water over here. That's what usually happens. You can see here, same thing happened here. You know, if we get that big sell-off, this will come up really, really quickly. All right, so that's the VIX. Okay, now our yields. This is the 10-year yield. When the yields go up, the market pulls on back. As the yields pulled on back, the market went up for the last month. Well, now we're kind of at that trend line. We're kind of at support right now for either that move up, or if recession really sets in, recession fears, the 10-year yield will continue to come down. So we can see maybe if we get a break of this to the downside. That's the 10-year Treasury yield. Over here is the dollar index, still up a huge amount from the beginning of the year. And you can see that our market looks like the opposite of this. So when this is going up, our market is struggling and going down, started to pull on back here, which is a very good sign, but also suggesting possible recession fears. So, you know, we'll just have to keep an eye on those things. I hope that you guys enjoyed this weekly watch list video. If you did, hit the thumbs up, and I'll see you back on the next one. Take care, guys.